Let's talk to Chris Justham. He is an investment manager at Seven Investment Management. Very good morning to you, young Chris.
Good to see you, Moose.
Happy New Year and all of that.
Happy Valentine's Day.
Now, there's the thought. Boom, boom. Right, stock markets. In terms of the fundamentals, I don't remember looking back when things were so rosy. Stock markets, always forward thinking, 6 months, 9 months, 12 months, okay. Clearly volatility has returned, worries about interest rates, inflation. You are running a huge amount of money. How do you cope with this on a day-to-day basis? And what has actually happened?
Well, I think to answer the second part of the question first, and then what we're actually doing about it. So we've got about 12.5 billion under management, and we manage money for retail clients. So you've got to think these are people who've got pension schemes. They've worked incredibly hard over arguably 30, 40 years. And the first thing that they don't want is to lose the stuff. Yes, they want to invest it to gain some money, but they don't want to take any unmitigated risks that are wildly directional, I suppose, one way or another. They would rather get a specified level of return within a risk budget. So that's always in the back of our minds. We've been talking about for a little while now that whilst the global economy, so we're using words now like expansion rather than recovery we see in the press, whilst that's sitting at around a 7 out of 10, if you want to put a number on it, synchronised global growth. We think the markets are priced in, when you look at valuations across the developed world in particular, less so Europe, we think there's a bit of an opportunity there, but about a 10 out of 10. Certainly we look at the S&P and you look in the UK, and there's a bit of a disparity there. And for us, for a little while, we've been saying, look, we do think that there is reason to think that things are looking quite good. We do think this expansion story makes sense, but at the same time, if the sun's shining, it's not a bad idea sometimes to carry an umbrella. And what we saw last week with this surprise that came out of the US, and it was interesting to see Donald Trump, I think, tweet about that, the fact that big mistake, the stock market should be reacting to these things. I mean, never has a US president really looked so closely at the stock market and use it as a bellwether for how well he's doing. But it's interesting because obviously his tax cuts as well are arguably something that's inflationary, and that feedback loop could then feed through into the market again in due course. But something obviously you've spoken about a lot, I know, over the last week or so, but those two bits of surprise, if you like, that came out of the US was enough to send people into a bit of a panic, particularly those individuals who had been shorting volatility. So they got their fingers burnt, and we know that there's an awful lot of money that are pouring into these types of vehicles over the course of the last year or so, and understandably, and they've done well. I think we only saw something like 6 or 8 days of more than 1% moves on the S&P, which is remarkable. That you're looking at generational lows. But at the same time, we move from confidence into complacency. And I think blowing a bit of froth off in many respects, for want of a better phrase, isn't necessarily a bad thing. And I think it's acted as a reminder that these things don't go indiscriminately upwards. If your asset price is pretty much across the board rising, you need to start asking, right, are these supported? Now, I think earnings, if you look at some of the earnings that have come out over the last quarter or so in the UK, we have got lofty valuations in the FTSE 100. Yes, we need to think a little bit about currency and what might happen if we can see continued strength of sterling, given the fact that we saw what happened with the FTSE 100, of the rapid rise thereafter. We saw sterling weaken after Brexit. But at the same time, I think earnings there are about 5% lower than they were a quarter ago. Earnings are about 3% higher, but the FTSE 100, if you look at valuations, is 5% lower. Opportunity from our perspective. So we've added a little bit after that period of volatility last week, where we think that things look a little bit cheaper, and we do think that some of the earnings do support some of those companies there. And interestingly, the fixed income area is another part that we've not really liked. And we've seen some of the reasons why. Particularly, we don't like long duration, with the prospect of a more hawkish tone from Mark Carney in the last couple of days. An inflation number coming out of the US in the next day or so, or is it this afternoon? All of this stuff coming out now would point potentially to tighter monetary policy. They're taking the punch bowl away from the party. But short duration, that's something that we think is slightly more interesting at the moment. So a 5-year US Treasury is yielding about 2.5%. So more than it was even 3-4 weeks ago. But you're taking half the exposure to interest rate rises than you are with a 10-year. So we think that's a little bit compelling. And again, that looks a lot better than it did before these movements happened. So those are a couple of areas, if you like, that we're dipping into at the moment. But for us, it's not microwave fund management. We're not looking to make too many changes when things like this happen, because there are elements of correction. It's going to happen, sure as night follows day. I think that we have just been lulled into this false sense of security for a period now, this artificially benign environment that's been created, where people think that it won't happen to them, and it does.
Well, 4 points from me. record inflows in January in terms of money coming into the market, record month. Then you had record M&A activity since 2000, January 2000. Read this weekend, gold is old. Okay, now we've got the Bitcoin. I'm thinking, oh, goodness gracious me, this all sounds very familiar.
Frightening, yeah.
You know, and in terms of, you listen to people on the train, you know, I've overheard some people recently basically saying, oh, I passive invest now. Okay, I've decided not to try and work out, I just put my money away. And there's a generation of people who, for almost 9 innings, if we are in the 9th innings, have just put money away and we've only seen one-way traffic.
And I think those passive instruments are potentially quite dangerous in many respects because people aren't aware that, particularly markup weighted stuff, yes, it pushes the markets, it continues to push the markets up as things are going well, but it just follows that trend as they go down. You haven't necessarily got a hand at the tiller. And yes, you can have the debate about whether active managers, those people who are picking those stocks, earn their money. You know, that's in perpetuity, that argument, whenever you pick up a Sunday paper. But you're absolutely right. I think that every man and his dog seemed like they wanted to get some kind of exposure to something because they're worried about missing out over the last year. And when you do have headlines like Apple stock up by 40%, and this is something that people think, well, I understand the brand, and I know I've got an iPhone. Oh, okay, I might have a punt on that. The amount of people that have asked me, knowing that I broadly do finance or work in the city, what do you think about Bitcoin, Chris? Now's the time to get in. Or even worse, telling me I'm an idiot for missing out is indicative of the environment we've been in. And these are the same people that end up going very quiet when they end up having to taste, unfortunately, some of the downside. And that's not schadenfreude for me. That's not me reveling in the fact that people have then had to experience this. But it is an important lesson. And you're absolutely right that you have got people who have not experienced these bumps and these troughs. And they happen. We had Gordon Brown saying the end of boom and bust many years ago, and that was the precursor to the financial crisis, the worst in a lifetime. So whilst we do think, you know, coming back to that, it's important for me to mention, whilst we don't think that there is an imminent global recession or anything like that, there's going to be a catastrophic fall, the newspapers jump on this bandwagon too quick. And I think in many ways they're the architects of a destruction where that's concerned. I don't know if you saw yesterday on the BBC website, there was a precipitous fall, I can't remember the word they mentioned, in the US stock markets. It was off like 9 points. You know, this is normal trading range per day.
Total exaggeration.
People want news, and we binge, and whatever gets clicks, that's what.
Just before we go, got to ask Mr. Carney.
Yeah.
What's he going to do this year?
The smart money at the moment looks like a couple of interest rate rises, but this is the same guy that hung his hat on an inflation figure, the same guy that hung his hat on an unemployment figure as well, and quickly stepped back.
And I would just like to add, did a 3.5-hour marathon.
Oh, really?
Yeah, that's a lot of training required for that. Trust me.
Fair play. But I think, for me, you just got to wait and see, really. You've got to look at the rhetoric. You've got enough people poring over these things. Their thesaurus is open. And the route has to be back towards normalisation, because at some point things are going to turn. And at the moment, they haven't got a great deal in the kit bag that they can use if we do end up going towards that slowdown and recession territory.
Chris, on that note, thank you very much.
Thank you.